bank that's on campus. So we are located in Stamp Student Union. We're here today, right next to the bookstore, near the food court. So we're really excited to be here today to talk to you about considering home ownership. We received a few questions beforehand that were incredible. We love getting participation. So how we're going to get started is sharing a short presentation. We'll probably move through pretty quickly because we want to give most of the time to your questions. And if you didn't submit any questions or have any questions along the way, please feel free to put it in the chat. We'll monitor that. Or you're welcome to come off mute if you're brave enough, and we can help answer questions to the best of our ability. And if there's anything we can't answer, we'll be sure to find out the answers for you afterwards. We work with a lot of great partners in mortgage. We have real estate partners as well. So we're here to be a great resource for you all.
All right, so we will dive into the presentation real quick. Where is it? All right, so considering home ownership. Some of the goals for this workshop are going to be review the costs and responsibilities associated with home ownership, explain the loan and repayment process, and also learn how to find out if you are financially ready to own a home. So pro or con, we'll get into this list a little bit to try to weigh the benefits and negatives potentially of owning a house. So long-term value would probably be the biggest pro in this situation. However, you do need to make payments and you do need to pay taxes, but you can also kind of keep things the way you want to keep it fresh because it is yours to own. So we'll dive a little bit more into that. So having long-term value. Having a home, there's a housing market, obviously, and that goes up and down. Sometimes it's a little independent on what the economy is doing. Really just depends. It kind of operates in its own little field. But for, all intents and purposes, you would like to think that your home will gain value as you have ownership in it. So it's almost like an investment vehicle, right? If you buy something for $100,000, when you sell it, you would hope that would be $250,000, so you make a little bit of money. The con, however, is the value could go down. So it's not guaranteed that it is going to go up. So there's the positive, negative there. Second one is you need to make a payment toward a home. You also need to make a payment towards rent. The pro towards making a payment towards home ownership is that you're establishing equity in the house. So your principal balance, you start paying down the mortgage or the loan that you have, and you actually start having full ownership of that house. As opposed to rent, where every time you pay rent, you're not really getting anything back in return. You're just giving the owner rent each month. The con to making payments toward a house is it does require sometimes have a large down payment up front. And that can be hard to get because you do need to kind of build up some wealth in order to be able to make that purchase. You also need to pay taxes on a home. Pro to that is there's a lot of tax benefits, especially for first-time home buyers. We can get into that a little bit later on in the presentation and into some questions. There are some tax breaks and incentives to having a home. However, you do need to pay property taxes, and a lot of these differ by states, by counties. Just really depends on where you're purchasing the home. Sometimes it'd be pretty cheap, sometimes it'd be very expensive. And the last pro is you can remodel the home any way you like, so you can make it your own. You can paint it any color you want, you can put any furniture in there you want, you have full flexibility to do whatever you want with your home as you own it. But the con is you are, anything breaks, if your AC breaks, something costly, you are the one that is responsible to fix that, as opposed to renting where if something breaks, then the landlord will generally have responsibility in providing that.
So we're just going to go over briefly some common terms. We'll talk a lot about income, which is going to be required to show if you're interested in getting a mortgage, and with that, seeing a history of income. So having that proof of employment, lenders often look for 2 years of income history. or if you change jobs, having a few months to show that history. Debt to income ratio. So this is a percentage of how much of a person's monthly income goes toward monthly debt payments. So I know we had some questions around student loans. So they would kind of look at, okay, what do you owe monthly towards student loans, car payments, whatever else you might have as debt, and how that compares to what you bring in monthly to figure out, can you afford to take on a new debt? And then of course, credit scores. If you guys have questions about credit, we actually have a whole presentation we can, come back and give, or, give to you guys separately. And that is, credit scores look at a number of factors, such as like the types of credit products you have, the length of history, the on-time payments, and it comes up with a 3-digit score ranging from, I want to say, like 350 to 800 or 850. And that's going to show your ability to repay the loan. The higher the credit score, the better. It also will give you a better interest rate. And then a down payment. So this would be the lump sum used to purchase a part of your home. That shows lenders you're committed to the purchase. So you're not taking all of the value of the house as a debt, as mortgage, but you're putting, let's say, 20% down in terms of the value. And as we'll talk about, homes are pretty expensive. So that can be a big number, which we'll talk about a little bit more later on.
All right, so here kind of shows needs and wants. It walks through a scenario. Christina is a divorced mother of one. Her son is 10 years old, and she has a full-time job, but she works part-time on the weekends. So she created the spending action plan with her current expenses. So it kind of lays out her needs and her wants and what her monthly, bill is. This would be important for the future if you're looking towards that down payment or looking towards what you could potentially, afford. You're going to need to know what's kind of in your range. So you can see right here, she pays $300 a month on rent. So there's kind of an example of how you would break down maybe what you have allotted in your budget to go towards mortgage. So here goes her debt to income ratio. This is a different situation for Marta. Student loan payment 600, car payment 400, payment towards credit card debt is 700. So that's going to be $1,700 of debt each month, and $4,000 of monthly income. So her debt to income ratio will be 1,700 divided by 4,000, which we can do the math for you really quick. And that's going to be 42.5%. So we would generally like to see it maybe a little bit lower than that, but that's kind of how that debt to income ratio would be calculated. You take your total debts each month divided by your monthly income.
So here's a little bit more details about credit scores that I touched on in the last slide. So the factors that affect your credit score, payment history is one of the biggest. This is your history of on-time payments, any 30-day, 60-day, 90-day late payments. Those can really negatively affect your credit score. The amounts owed. So ideally, if you have lines of credit, if you use 30% of that line or less, that's going to give you a better credit score. Then they look at length of credit history. So this is something that's hard for people that are just graduating, because if you haven't had maybe a credit products like throughout college or grad school, you might not have a long history. So that is just the only thing that's going to make that one better is just time. And it's an average of the different credit products you have. So if you open a credit card when you were 20 and then take a loan when you're 25, it's going to average those number of years that you've had that product. And then types of credit used. So they like to see a mix of variable lines of credit, so like a credit card, and then something that's more fixed, so a car loan or a mortgage. But it shows that you have the ability to make consistent payments on different products. And then new credits. If you take out a new loan or apply for a new credit card, that will be a soft or hard hit on your credit. It'll go back up eventually, but that will affect your credit score. You can check your credit score for I believe most of the credit bureaus that are listed below, Equifax, Experian, TransUnion, do give it to you for free. I know it says there's a fee here. I think that's if you're getting it regularly. Or you can go to annualcreditreport.com, and they offer it for free once a year, and that's once a year for each of those 3 credit bureaus. So you can kind of strategically do it every 4 months and check one of the bureaus. Or actually during the pandemic, they're offering it for free, I believe, once a week, right? So if you haven't ever pulled your credit report, this is something I would definitely recommend starting with, because things like fraud happens. We're bankers, we see it all the time. So it's a good idea just to make sure that everything you're familiar with, everything looks good, and there's nothing that you don't recognize that could be negatively affecting your credit score. If you do have any types of credit products, I know a lot of banks will offer like a FICO score, a preview of what some of the factors are that affect your credit score. But these annual credit report will actually show like all the details, which is great.
And just to emphasize, if you haven't done it, you definitely should go do it after this. So there's one thing to get out of this, it's to go check your credit report. That's very important. Even if you have done it before, I would check it as frequently as possible. It's very important to kind of give you a snapshot of what's going on that's attached to kind of your social security number. So it's good to check up on that pretty regularly, just so you know where you stand financially. All right. So getting into actually buying a home, what you're going to need is a down payment, the miscellaneous costs, and the closing costs. And we'll get a little bit more into each of those 3. Oops. All right. So the down payment is the initial cash payment toward the purchase of a home, typically between 3 to 20% of the purchase price. Marta wants to buy a house that costs $80,000. See how having a down payment can affect her interest rate and other costs. So scenario A, Marta doesn't have any cash saved for a down payment, so she will need to borrow the full amount. So she needs to borrow that full $80,000. Down payment's going to be 0. The interest rate that the mortgage officer gave her is going to be 5%. So at the end of the first year, she will have paid $3,900 in interest. As comparison to scenario B, Marta saved $20,000 for a down payment. She needs to borrow only $60,000 from the bank. The down payment, $20,000. The interest rate they give her is 4.5%. And at the end of the year, she will have paid $2,700 in interest. So this is an interesting situation for me because mortgages are very long term. So when you think about $1,200, it might not seem like a ton when you're buying a $80,000 house. But when you multiply that over 30 years, which is pretty standard for mortgage, that ends up being a lot of money. And the way these loans work, as you continue to pay them down, the principal amount, so the amount that you actually borrowed from the bank, will start to decrease and decrease, which will eventually end up in you getting charged less interest. So the fact that in scenario B, Marta only had $60,000, as she pays that loan down, it'll be less and less interest paid each year, which would be the same for scenario A, but it's going to take her a lot longer to get that interest payment down to where she wants it. So this kind of shows you what a down payment can do towards the cost of a house and the life of the loan.
And one disclaimer I'm just going to give is that a house isn't going to cost $80,000 in this area. If you're looking to stay in the DMV, it's not going to cost you $80,000. It's going to be much more than that, which really shows the amount, kind of really explains how much you need to start saving to be able to make that down payment. Sorry, we're just taking a look at the chat.
So the FICO scorecard is kind of a combination of the multiple bureau reports, and it kind of has its own formula. And sorry, I'll repeat the question. How accurate is a FICO credit scorecard in a credit card app like Discover? So back to the answer, it kind of combines all the different reports. So your Experian, your Equifax, and then it kind of formulates their own score for you. So it's a general ballpark. It should be a pretty good estimate of where you stand.
But it can often be a little bit higher, as Omar mentioned. So thank you.
Yeah. So
yeah. There's one new chat. Just scroll down. Oh, okay. Thanks, guys.
You guys are having good conversation.
Love it. So then next is a lot of miscellaneous costs. For doing a credit check, you often pay a fee. When you find a home you like and you want to put an offer in, you're going to want to make sure you do inspections. That is so critically important. The last thing you want to do is move into a house and then you need a new roof, which can cost like $20,000. And you have to pay for that. Like there's no, you already got your mortgage, you got to pay for it now. So making sure you get a good inspection done. The cost of the appraisal, that's checking out the value of the home, making sure that it's up to kind of like the market value that you're paying for the house. Earnest money, this is showing the buyer that you're serious in purchasing the house. So you can it might be $2,000, $10,000 saying, hey, something does go through, like this is my commitment to you that I'm going to pay this amount. In the event that something negative happens and I have to walk away, it kind of shows I'm earnest in purchasing this home. And then if there's any repair costs, sometimes there are things that you want to fix. And sometimes those things can be negotiated when you buy the house. Sometimes there are things that the buyer or the seller will agree to. Sometimes it's the cost of the buyer. So there are some repairs that usually have to go in when you purchase a house. And then ongoing costs could be any type of maintenance and things. I think that's what it means once you buy the home, all the costs of just keeping it safe and all that, keeping everything up to snuff.
Here's a little bit more about closing costs. Hold on, we'll check the chat real quick.
It is not part of the down payment, so it's not going to the lender, it's going to the seller. It's additional, and it is basically, I would say, like a deposit. That's the best way I would describe it. But it's not something you necessarily get back. Mm-hmm. So if you do have to walk away, hey, maybe you lost that $2,000, but if you don't have an earnest fee, they might not consider you and accept your offer. Is it common for condos to be sold as is? It just depends. There are things that need to be repaired in condos too, such as, HVAC systems, mm-hmm. Electrical issues, things like that. Making sure there's no mold, things like that. So there could be some things that need to be fixed, but they might not have all the same issues the way a single family house would, such as maybe like a roof or yard. So it can just vary, I would say.
All right, so closing costs. These are expenses over and above the purchase price of a home. Common closing costs include, but not limited to, appraisal fees. So that's essentially someone coming out to make sure that the house is worth what it's listed for. Tax service provider fees, so then that's talking about the homeowner's tax. Title insurance, government taxes, prepaid expenses such as property taxes, homeowner's insurance if applicable, and interest until your first payment is due. So the closing costs can be a lot, of up to a few grand generally. We'll get a little bit more into it. I know some of the questions mentioned some grants and things of that nature that go towards closing costs, so we can touch on that a bit. But there are certain ways you can kind of get the closing costs to be reduced.
And then one thing I just want to add about cost of like home buying in general is it says homeowners insurance if applicable. So that might be if applicable to the closing costs, but you do always need homeowners insurance if you are buying a home, and there is usually like a monthly, quarterly, or annual cost associated with that. And that really is a benefit to you as a homeowner to make sure that if there is a storm, flooding, like theft, burglary, like those things happen, unfortunately, and you want to make sure that you're protected, just kind of like how you are required to get car insurance or like if not pay a fee, you want to make sure you have homeowners insurance as well.
And a question came through the chat: are these different than the appraisal fees mentioned in the previous slide? No. Once it would be the same appraisal. Okay. Private mortgage insurance, often referred to as PMI. This is insurance that guarantees the lender will be paid the amount of remaining mortgage if the buyer defaults. And who needs it? Anyone who can't make a down payment equal to at least 20% of the purchase price. So this is a very important kind of thing to go over because it's pretty common. If you don't provide 20% of your down payment, you are going to have to take out some form of PMI. And what that essentially means is because you don't have a ton of equity in the house. So let's say if you put a 20% down payment, that means you automatically own 20% of the house. So the mortgage lender already recognizes you as having skin in the game, right? You have a reason to pay the mortgage because you own 20% of the house. However, if you put let's say down payment down to 5%, the mortgage company thinks you're a lot more likely to default or essentially walk away. And that would be because you don't have much equity in the house yet, right? You only own 5%. So the private mortgage insurance will talk to between that. So if you put a down payment down to 5%, you need to get to 20%. Until you have 20% equity in that house, you're gonna have to pay private mortgage insurance each month. That can range to $100 a month to $600 a month. It really just depends on the personal credit score, the value of the home, a lot of different factors that go into that. So when a lot of these questions we'll touch a little bit on too, in terms of what you need for a down payment on a house. Ideally, you're always going to want to have 20%, but there's a lot of different factors that can come into play where it's totally fine to not have 20%. You just have to recognize that you might be paying private mortgage insurance for, a year or two for the mortgage. So we can get into that a little bit more in detail after the presentation. I know that one is pretty important and can get a little confusing. Just check the chat real quick. How is a PMI amount decided? Is it mostly geographic or is it mostly based on credit? It's going to be pretty much solely based on credit and, your down payment size. There might be do you know if there's any geographic reasoning to that? I think it's just credit and down payment size. Can we get the PowerPoint? Yes.
We can definitely send out this PowerPoint.
And it's also being recorded, so you guys will be able to go back and look through it.
There are two major types of loans. We have conventional and non-conventional. Conventional loans are mortgage loans, probably the most common, what you think of if you hear mortgage. And it's for people who meet a certain level of criteria. So income level, DTI, which is again, debt to income percentage, and credit score. These loans are provided financial institutions, pretty much all banks that I know are eager to sell mortgages, credit unions, and there are even direct mortgage companies as well. So sometimes people shop around to see what best interest rate they can qualify for. But there's a lot of different avenues you can go to getting a conventional loan. Then we have non-conventional loans, and these are government loans available to buyers who may not have good credit or a large enough down payment. So a really common one is the FHA, so the Federal Housing Administration. And this can help insure your loan so you're able to get a better deal through a private lender, such as the bank or mortgage company. So if you start working with a mortgage company or a bank, or even the real estate agents will kind of give some advice around this. If you aren't able to meet the conventional loans, they'll talk about the different programs that they offer. Then we have the Veterans Administration, also known as the VA, for eligible veterans, service members, and surviving spouses. They similarly can guarantee a portion of the loan from a private lender. And then we have the USDA Rural Development Services, which is if you're looking to buy a home in a rural area, they offer several types of loan assistance programs. So if there are things that could apply to you, a good mortgage partner will be able to kind of go through those different options with you. And we'll just go check the chat. So it's only if you don't meet the requirements. If you're eligible for conventional, the FHA wouldn't be coming in, from my understanding.
Yeah. All right, so these are some resources, that are just out there where you can go check, and if you have certain questions that may pop up. The Truth in Lending Act, which requires that buyers be given information about the key features, costs, and risks of their mortgages, including their loan estimates and closing disclosures. The Consumer Financial Protection Bureau, CFPB, provides protections and resources for buyers when financing a home. The U.S. Department of Housing and Urban Development, which is commonly referred to as HUD, may have helpful resources, including the Fair Housing Equal Opportunity Act, opportunity for all, information about borrowers' rights, home buying programs. I know a lot of those were spoke to in the questions we received. And then the last resource, the USA.gov, finding a home site can be found at usa.gov/find-it-home. Not sure what I read that one. Check the chat real quick. Are these available for someone on F1 visa? I am not positive. We can reach out to one of our mortgage partners and see if M&T specifically offers that. I would think that's going to differ between lending, different lending organizations, and kind of what they offer. But in terms of M&T specifically, I would love to go back and see if we do offer that.
And then I'm just going to put in the chat the name of the website, annualcreditreport.com. If that didn't work, I'm going to have to copy and paste. I don't have a hyperlinks, but that's where you can access free credit report. And it is a trusted site by the bureaus. It's there are other credit report sites out there, but they often have fees, or you want to make sure that you're not giving your personal information to a untrustworthy site, because that can often lead to like things when they kind of like fraud or start sending you different loan offers and things like that. So it's really good to make sure you're using a reputable site such as Annual Credit Report to check your credit score.
I
I don't think so.
Okay.
So that concludes our deck. We're going to kind of look through the questions to make sure we covered everything. And if you guys have any additional questions, again, keep using the chat. We love questions. So, feel free to ask anything that's on your mind.
All right. So Debbie shot us an email. So I'm just going to read through some of the questions and kind of ask as we go down the list. I'm a staff member and a grad student. I'm interested in learning more about financial readiness. What's an ideal down payment for a home? So this kind of goes back to the PMI a little bit. It really just depends. You're going to want to put down as much as you possibly can. That's always going to help you. And that's true for any loan, whether it be a car, a house, whatever it may be. You're going to want to put down as much as you can afford to put down. That'll, shorten the period potentially, and also shorten your interest payments.
And just as bankers, I can't stress enough how important it is to start saving early. A good rule of thumb, if you're just starting to save now, is to save 6 months of living expenses. And what that is for is to, protect you from any large costs. Let's say you need to get new tires on your car, or if you have any medical emergencies, or if you lose your job for a couple months, it's really important to have some money set aside for that. And then you can start and set goals. So, I would make a goal of 20% down payment if possible. And, there are a bunch of great sites like at our bank, we have Money Smart, which creates you can make goals around budgeting to help you get tips on how to save, how much you should save each month. There are sites like mint.com and different sites out there that can help you make a savings plan. I see a couple questions in the chat, so I'm just going to read through those so we don't lose them. Can you purchase a home if your income is mainly on a fellowship? How would that be navigated? A fellowship, is that temporary?
Yeah, I would think, and I'm not positive. I'm jotting some of these questions down. So the one lending on an F1 visa, and also with the fellowship question, things I'm going to take back and see if I can get an answer for. I would think if fellowship income would be somewhat temporary, so that may be a little bit difficult. Generally, we, banks and lenders are going to gravitate more towards permanent, jobs and permanent income streams. But I will go and double check that for you, because I can't give you a positive answer.
Do you have any tips for finding a good realtor?
Ask around.
If you're new to the area, feel free, reach out to me or Matt after this. I know a bunch of great real estate agents in the area, through customers of the bank, through personal connections. So, start with someone, bankers will know a lot of people if you have a banker you trust. Maybe people's parents, if maybe you don't have friends yet who are purchasing their homes, maybe their parents did. But yeah, if you have specific questions, feel free to reach out to us afterwards and we can, give you some names, especially depending on what area you're looking in. You want to make sure you have a good real estate agent that is familiar with that area and can help you and be a good resource for you. What areas do you recommend looking for a home in the DMV area? Ooh, that's a good question. You want to look at areas that make sense for you. So, where are you going to be working? You think about your commute. Maybe you want to consider where your friends or family are. You also, there are so many different areas in the DMV that price really varies. So that's just something you want to consider. The safety of the area, there's just so many factors. Location is everything when it comes to buying a house. So there's a lot of really important things to consider.
Yeah, so just to continue on that, I mean that's all personal preference really, and it's about where you are in your life. If you are kind of just graduating, you want to be kind of in the city life. You don't necessarily need a ton of space. You don't have a family yet. Um, you know, you might gravitate towards a different area than if you're starting a young family. You want a backyard. You want bigger space for the kids to run around, or maybe you have a dog. So it's really just a ton of factors. And when you get a realtor, they will kind of help narrow that down for you and talk about what exactly you're looking for.
And then the follow-up question was, if you're looking at two different areas, such as College Park and Tacoma Park, do you get multiple realtors? I would say no. You want to it's easier to work with one realtor that really can get to know you, know your preferences, shop around. And for areas like we're looking at College Park and Tacoma Park, to me, they're not that far away. The realtor should be familiar with both areas and be able to find you a home and help you kind of look around and figure out what makes sense. So I'd say for most of the areas, and I would say too, even in this area, a lot of people are licensed in DC and Maryland, or Maryland and Virginia, or whatever the case may be, so that they can work with whatever their clients' needs are. How can we contact you? We can put our information in the chat box, and we can hopefully have Debbie maybe email out our contact information as well as this PowerPoint after the workshop.
Okay. Just gonna keep going down this list because we still have a lot. Should I start with a small property like a condo or apartment, or go straight to buying a house? Again, this is kind of like the question a little bit before. It's really personal preference. Depending on your needs, your wants, where you want to be. It really just depends. Now, if we're talking about renting a condo apartment versus buying a house, so let's say you're just coming out of school, and you're, a little between renting or buying, that's kind of more of a personal financial goal that you need to, kind of set yourself and go through what you're looking at long term. Maybe a short term goal of 2 to 3 years to purchase a house, and you're okay with renting that time period as you kind of figure out where you want to be and what you want to do.
I would say also some people want to prefer buying a condo because they don't want to deal with some of the things that a house might have, like such as yard upkeep. Maybe they, like, I know a friend, they don't want to be out mowing every week. They'd rather live in a condo. And also the price is going to vary as well. And then another area, I don't know if we talked about this as another cost, but homeowners association or HOA fees. That's something you definitely want to look at when you're looking at a house. HOAs for a condo can sometimes be really high. Same for a house, depending on what neighborhood you live in. But sometimes if you see like a condo might cost less, you want to also factor in that monthly HOA fee. So it's really, again, to Matt's point, personal preference, but also kind of what makes sense with your needs, your budget, the area you want to live in, and all of that.
Yeah, and as we kind of go through this list, I feel like a lot of the answers we give might be a little bit on the personal preference train. As you get deeper into the home buying process, when you do connect with that realtor and the loan officer, they will be able to kind of flatten out your needs a little bit better and give you more pinpoint suggestions on where you might want to be. Just for general purposes, we don't have all the information to do that. So just a fair warning if that gets a little repetitive. Looks like certain home buying seminars make you eligible for special first-time home buyer deals. Are these more or less the same? If not, do you have any recommendations or favorite workshops in PG County? I personally have never participated in any home buying programs. I know first-time home buyer programs are very, very big, and those differ by state as well as county, depending on where you are. So Maryland will have certain home buying programs, and DC will have certain home buying programs. A lot of times it is for first time home buyers. A couple other programs they have depend on the income level. So if you fall within certain bands of income, you might qualify for, a grant here or there. Um, Again, this is a more question as you're looking for the first time purchase. Your loan officer will really be able to give you more specific details on which home buying program is going to be right for you. I do know that a lot of these give you a few grand or so, let's say like 3 to 5,000 towards closing costs or towards your down payment. Um, so they really do help in terms of buying your first house. There's also programs for refurbishing houses. So if you're buying a house that might have been foreclosed on, or someone hasn't been living in there and you're planning on buying and kind of doing a fixer upper, a lot of cities in Baltimore and DC will kind of give you a credit towards purchasing that house as, kind of to bring the overall being of the city into a more positive light. So those are just a few programs on the top of my head that I know of.
The next question is, what are some things we should keep in mind if we end up renting out a room from a home we buy? That's a thing that people sometimes do a bit because that income from the rent can help pay for that monthly mortgage and can significantly lower to make you have a little bit more income for yourself personally. So that's definitely something that a lot of people consider. Of course, you are dealing with kind of like a roommate, unless depending how separate that room is or not. I would definitely recommend having a lease agreement. I don't know of any terms in terms of tax implication. Sometimes there are, you have to make sure that it's okay with the HOA or the neighborhood that you're in. They might have different rules regarding renting out a room. So it's really going to depend on the property.
Yeah, and taxes, I know, any rent is going to be taxed as pretty much income tax for you when you do your yearly tax returns. A couple other things to consider go to just wear and tear and overall maintenance of the house. I've personally rented a few houses in my life, and a lot of things go wrong with rental properties. So if you are renting out, a room to someone and you're not necessarily sure on who they are, maybe something breaks, you ultimately will probably be responsible for paying for that. So just another thing to keep in mind that you're sharing your space with someone else, but a lot of the liability still falls on you. That being said, it's a great alternative for people to purchase homes. It's a great way for people to make money. It's a great way to pay off your mortgage quickly. So there is a lot of upside to that.
Just make sure you do a background check.
Yeah. All right. Can you talk about a financial plan for buying a house, the reasonable debt to income, and any tax guideline? Financial plan, it's going to vary, but the big thing is just putting money away, right? So taking a certain percentage of your paycheck each month and maybe dedicating that towards a savings account, making sure you don't touch that. And even if it's only $100, $200 a month or even less than that, that's going to build up over time. And all of a sudden 2 years are going to go by and you're going to be, sitting there with a good chunk of change where you can actually make something happen. So that's kind of my best advice for you would to be just start putting money aside in your savings account. Reasonable debt to income, I'm not positive on. I can take a look into that. Sorry, just writing that down. Again, a lot of things with credit and underwriting and mortgages, especially these larger loans, is things are going to be very specific to each application. But I'll see if I can find a more specific, reasonable debt to income for you guys. And in terms of tax, I'm not too positive on tax. So that entire question, I'll pretty much reach out and see if I can get a little bit more guidance on for you. Just writing it down. Give me one moment. Okay. Yeah. How far in advance should you contact the lender and or realtor? If I want to start seriously looking in the fall, when should I contact them? I would say probably towards the springtime. With closings generally 30 to 60 days on a house.
30 to 60 days is standard.
Yeah.
I would say leaning more towards 60.
That's once you have the pre-approval and you really start deciding you want to purchase the house. I'd probably go towards a 2-month range or so when you're actually going to be moving in. That doesn't include the time that you're taking to look for a house. Maybe sitting down with the realtor and trying to discuss what areas you're looking for. what kind of properties, what residences you're looking at. So realistically, you might want to start looking 3 to 4 months in ahead. Um, that being said, you can get on some websites, Redfin, I think vrbo.com. They have, just resources for what's available in the market currently, where you can start kind of gauging your interest and maybe narrow down a little bit on yourself what you're looking for before you take it to a realtor. But that's what I would recommend doing. I personally like just looking to see what houses are on the market and how much they're worth. I think it's pretty cool.
It's fun.
Yeah, it's just like, how do people have this much money? But beyond that, it's pretty entertaining to me.
And to answer about the debt to income ratio, the ideal amount is lenders prefer to if it's less than 43%. So that's kind of the target goal, to have your monthly income before taxes, how much of it goes to debt, to be 43% or less.
Can you purchase a home if you are on a visa? Again, I'm not positive on that.
We'll follow up on the visa
Yeah.
questions. I think it probably varies
Mhm.
per lender and situation. I do know from just lending in general, it can be more difficult if you are not on a permanent or citizen status to get certain types of loans. Again, that's something that does vary by lender and by products and things. But that is a great question that we'll get more answers on.
All right. I believe you asked about how far in advance you should contact the lender. So yes. And a realtor, you might be in touch with before the lender per se. But again, I would give kind of that 2 to 3 month, timeline there.
And a lot of times if you work with a realtor, they'll probably suggest that you get a pre-approval from a lender. This kind of gives them an idea of how much of a mortgage you would qualify for, to make sure that the realtor is showing you properties that are within that range of something you can afford and likely get a mortgage for. And if you are not sure what lender to go to, realtor can also kind of give you different people that they've worked with, or you can go to your bank. But I would say a realtor is a great place to start with, because they can really give you information about, what kind of products you qualify for, help you kind of narrow down your search. So I think that's a great place to start with, and then getting a pre-approval offer. I don't think there's ever like too early. Maybe if it's a few years before you're ready, that it's going to be tough, because especially in housing market today, houses are going off the market within a couple days. It's a very hot market right now, but it is good to kind of get started working with them as soon as possible. So if the right house for you opens up, or if there are some things you need to do to get ready to be able to make an offer, they can help you with that and get you in the right place.
As recent college grads, how much work history should we have to be approved? I wouldn't say work history is a huge component. The big thing is going to be your credit. And so that's going to have more to do with, your credit score. So your length of credit. In terms of work history, generally if you're renting a place or buying a place, they might require a few pay stubs, just to show that you are actively employed. But beyond that, I don't think work history would have too much of an impact. Real estate agents have the tendency to recommend and impose their own local lender agents. Can we tell agents which lender we want to work with, especially if there's already a pre-approved letter from a financial institution? Is there a risk associated with consulting many lenders? That is a fantastic question. You want to go ahead?
I would say you are absolutely able to choose whatever lender you want to work with. Definitely a real estate agent is going, especially if they are familiar with the lender, or sometimes I know like certain real estate agencies have different like mortgage companies affiliated with them. So a lot of times they'll just kind of cross refer. That's a really common thing. But if you already have a pre-approval, if you have a lender you trust, absolutely work with that. I don't believe they can tell you have to work with one lender. They are not allowed to do that. So it's okay. And a risk associated with getting consulting many lenders, I would say no if you're doing it within like a short time frame, because that's what people do. They a lot of times, especially even like the credit bureaus know if you're getting kind of multiple pre-approvals, it's because you are rate shopping, I wouldn't say, which is really common, especially within mortgages. They're very much a rate driven product. The best interest rate that you can get is often what people try and get. I was gonna say something else and I lost my train of thought. Jump in.
Yeah, but you can totally, choose your own financial institution or whichever one you want to use. I would
But
think,
when you do a pre-approval, it is a credit pool.
yeah, that's what I was going to touch on a little bit. There's definitely no issue with consulting many lenders. I think that's a responsible thing to do. Just to see, who you like, who do you think is going to be good. I mean, this is most of the time going to be a 30-year commitment, right? So you want someone that you trust and someone that's going to give you a good rate. But you do need to be careful that if you are about to purchase a home and these pre-approval letters are technically a hard pull on your credit, I mean, it might lower your credit. So if you go to 3 or 4 lending agencies, that's 3 or 4 pulls on your credit. And let's say the 5th one is the one you really want to work with. Well, you might get a way worse rate because there have been 4 pulls on your credit just before that, and that'll temporarily lower your credit. So just something to keep in mind if you are kind of going to different lenders to make sure that they aren't necessarily pulling your credit, and they have to disclose that they will be. So, how long is the pre-approval valid for? I think that's like 2 weeks, a week or 2 weeks. Is it longer than that?
No. I think it's like 6 months.
Oh, is it that long?
Yeah, because a lot of times he's allowed to stop for a house. It's definitely.
That's true.
I think it's 6 months, but we'll double check.
Double check on that.
Okay, so yeah, I mentioned it's a very hot housing market. Any tips for how to navigate this kind of market? Making sure you are ready, you have your ducks in a row, like your pre-approval, real estate agent, because I'm actually in the housing market for myself right now. People are like, at least in the area that I'm looking, people are offering over asking. Houses are going quickly, so if you're not ready to kind of make an offer within a couple of days, you might lose out on that opportunity. So really making sure that you're comfortable with what you're looking at, ready to take action, I think are going to be important things. And then also just, looking, like as Matt was talking about, being on Redfin, Zillow, like I love just kind of looking at the housing market, seeing what's out there, knowing what's maybe like a deal breaker for you or what's something that you must have in homes. I think is going to really help with that as well.
All right, so just browsing through some of the other questions we have. If you sent us a question and we might not have answered yet, feel free to put it in the chat. It's a little easier for us to follow that way. But here is one. Is it necessary to use a realtor? What to look for in resale value? How do you make sure you're making a good investment? How much your structural issues cost and affect the value of home, and how much negotiating power do you have when the home is completely outdated and is in need of hefty renovations? So a lot of this is just going to depend, right?
I'm going to say if it's your first time buying a home, I would definitely recommend using a real estate agent. They can really help you kind of navigate all the different territories, make sure also when you make an offer, there's a lot of negotiation that can go into that, and they're going to be really qualified to make those contracts, negotiate on your behalf. And then kind of going back to one thing about what I also mentioned, asking about the hot market is, sometimes you kind of have to be okay with getting your heart broken. Sometimes, like I know, I've made a couple offers on houses. My offer didn't win, and you might get your hopes up. So sometimes this process does take a while, and that's why kind of going to that pre-approval it kind of lasts for a few months, because you might not always get that first house you put an offer on. So just kind of being okay with that disappointment, but ready to kind of get back out there and keep looking. And sorry, the other parts of the question.
I was going to touch on the structural issues and the repair and the investment. I don't really want to speak on it. Really just depends. But especially for your first time, unless you have experience in that kind of field and how much it might cost, you might want to go the safe route and not have a house with structural issues. Just because that is a big concern, and it will affect the value of the house pretty heavily. So just keep that in mind going forward.
Yeah, those are very expensive.
Yes.
Very expensive to repair.
Yep.
What are we targeting for getting the best interest rate? So I would say what's considered an excellent rate is anything above 750. 700 is in between 700 to 750 is still a great credit score, but I believe you were 750 or maybe sometimes it's like 780, depending on the lender, is going to give you the best interest rate.
Yeah.
Um,
I would shoot for above 750. And just speaking from personal experience, I graduated from UMD 2 years ago. It is difficult to have a great credit. The biggest thing that was affecting my credit score when I graduated was my length of credit. So it is something that'll gradually get better over time, and it does take a little while to get up towards that 750 plus range. But if you're pretty new to credit scores or new to a credit card, if you're making those payments every month, you'll see pretty quickly in 2 to 3 years you'll be up to exactly where you need to be.
Yeah, when it comes to credit scores, just be patient. Make sure you're making all your payments on time, and you're not using your credit too much for things that you potentially can't afford. And that's going to really just help build it up over time.
Okay, here's a good one. I heard there are some first-time home buyer programs that allow you to use the funds from a Roth IRA or for a down payment. Do you know anything about this? Yes, you can essentially borrow against your IRA, whether that be a Roth or a 401k.
Or a traditional IRA, I
Or
believe,
traditional,
right?
which is a 401. Sometimes. Yes.
No.
Traditional or Roth IRA, you can borrow from. That is a decent option. People do it pretty frequently to afford that down payment, and also it gets them away from the PMI sometimes. However, you essentially are taking a loan out. So when you do that, there will be certain terms where you have to pay that money back into your IRAs. Also, one thing to note, with IRAs and retirement accounts, one of the big things why people get into them so early is for that exponential growth. So if you're taking a large chunk out of one of your retirement accounts, it might not yield the best dividends going forward. Just multiple things to consider there if you are thinking of going that route. What time frame allows for a better credit score? It won't negatively affect it anymore. So if you're talking about the length of credit, I can tell you I think I'm running on 5, and it's still kind of a yellow mark on my FICO score. So it's still not like as long as it needs to be. I'm not sure, probably 10 years or so, then you'll really be in that outstanding range. But you can still have a good credit score once you hit about, probably like 2 years.
I think she's also asking if you take a credit out, like if you have a hard hit on your credit, how long does that affect your credit score for? Which I think is a few months.
Yeah, I would say a few months. So we're out of time, so I won't get too into that.
Yeah, there's no exact science to credit scores. And as I mentioned, there's going to be a presentation on March 9th that will go into credit scores. And if any of you guys are affiliated with clubs or organizations, we can host this workshop for your organization, and we actually have one on credit scores and reports that we'd be happy to do a presentation for, or even just a group of you guys. It could be anything informal, or come on into our branch and we can go over some of our materials and things like that with you guys anytime. You don't have to be a customer. We're here to help. All right, I think I'm not seeing any new questions in the chat. We're almost at time. I'm going to say we're just so thankful for all of your participation, all your questions. It really helps make it much more engaging if we're not just talking at you, but being helpful to you and answering your questions. So hopefully we did okay. And there are some things we'll be following up on. And as Debbie put in the chat, she'll be sending out our deck as well as our contact information this afternoon. So if you guys have more one-off questions, feel free to reach out to us. We'd be happy to set up an appointment or a phone call to discuss things further with you guys.
Thank you very much for the time. It was great. You guys were very good participants. So we always appreciate that, as Brittany said.
Right. This is Debbie. Can you all hear me?
Yep.
Okay, great. I'm unable to get my video on. I apologize for the technical issues, but wow, what a fantastic workshop. Matt and Brittany, thank you so much. You're such a great resource for us and our students. And students, thank you so much for all your questions and just for showing up. I know it's hard to make time for such things, but it made for a really rich workshop. So thank you, everyone. We've got another workshop coming up next week, and it's on F1, J1 visa. What's next? So everyone have a great week. Watch your email for a follow-up to this workshop, and have a great week, everyone.